Hey everyone, good morning and welcome back to the channel. Today we need to talk about some massive reality checks because Citigroup and Goldman Sachs just dropped a couple of serious warnings that are going to be worth paying attention to. Look, I know you see the headlines and you think the economy is magically recovering or that you are suddenly getting richer because your favorite tech stock jumped 5% yesterday. But let me drop some truth on you right now. Most ordinary people are actually getting poorer by the day because they do not understand the hidden macro forces ripping through their purchasing power. Wall Street is currently playing a highly leveraged high stakes game while the average retail investor is just sitting there waiting to get scalped like a total amateur. Before we dive deep into the specific warnings from Citi and Goldman Sachs, let us do a quick pulse check because I want to see who is actually watching this and taking their financial future seriously. Do me a quick favor and drop a comment right below this video with your current age and the exact dollar amount you are realistically aiming to invest every single month. I do not care if it is $50, $100, or $5,000, just type it down in the comments right now because tracking your data is the very first step toward building genuine financial freedom. Seriously, pause the video, comment your age and monthly investment target below, and let us hold each other accountable as a community. All right, let us start with the first major red flag coming out of Citigroup, which is something that has been gathering a ton of steam lately. Citigroup is pointing directly at long and weakness in the bond market, which is completely driven by a massive reconsideration of inflation risks amid incredibly sticky economic data. On top of that, we have got a total geopolitical stalemate on the United States and Iran front. Because of all this chaos, the United States dollar index has been rallying hard, coming up off its recent lower levels. Now, what does a surging dollar actually mean for your personal portfolio? When the dollar gets super strong, it creates a massive foreign exchange drag for giant multinational American corporations. Think about a company like Apple, which sells a massive absolute ton of products outside of the United States. When Apple earns money in foreign currencies and then has to convert those profits back into strong US dollars for their quarterly earnings reports, their total revenue numbers look significantly worse. This foreign exchange impact is exactly why we often see major corporations suddenly miss their earnings targets even when their underlying business operations seem totally fine. It is also the exact reason why Donald Trump historically preferred a weaker dollar, because a weaker currency incentivizes international buyers to purchase more American goods. But Citigroup did not just stop at currency warnings, they also highlighted an incredibly telling technical warning that you need to hear. They pointed out that Applied Materials recently had a massive earnings beat, but it completely failed to drive any kind of meaningful post-market stock rally. This is an incredibly clear and telling sign that official tech fatigue is starting to emerge in this market. The sentiment indicators are flashing bright red with massive overbought conditions across the board, and multiple sales traders are warning that we could see a very sudden and very painful sector rotation. Now, it was hilarious reading the Citigroup piece because they literally wrote that software could be due for a massive short squeeze. I do not typically write or speak in that exact phrasing, but that is exactly how these Wall Street analysts are talking behind closed doors. And look, I am not just pointing this out to brag, but if you remember my market commentaries from the beginning of April, I explicitly told you that the hardware and semiconductor rally would peak first and that a massive software rotation would be the next logical step. I truly hope that thesis plays out because I want to be right on the money for you guys, but I will gladly take some egg on my face if the software rally delays. The real lesson here is to look at a giant like Applied Materials as a leading indicator. When a company delivers flawless earnings and the stock still goes straight down, that tells you the tech sector has reached an extreme valuation level where it is desperately due for a massive consolidation phase. You can see this exact same speculative fatigue playing out in the recent Cerberus initial public offering. If you watched my full dedicated IPO breakdown video on Cerberus, you already know that people were running into that stock with pure unadulterated retail FOMO and YOLO energy. But since the exact hour it priced at its IPO, the stock has been moving straight down in a brutal tailspin. I would not be shocked at all if it keeps dropping like a stone, because if you actually strip away the accounting smoke and mirrors, the only reason Cerberus showed a GAAP profit was due to a temporary change in the valuation of their corporate warrants. Otherwise, this is a completely unprofitable money-losing business. They are literally going to transition from shouting, "Look at all this money we make," to, "Oh wow, we are actually losing hundreds of millions of dollars." That is going to create immense downward pressure on the stock, and it serves as a perfect warning sign for the broader tech and artificial intelligence sector. Now, my long-term core thesis has been that the upcoming SpaceX IPO is going to be the ultimate driver for hardware and infrastructure spending across the globe. SpaceX is looking to raise an absolute minimum of $80 billion, but honestly, they will probably raise closer to $100 billion. To put that into perspective, that is basically double the size of the legendary Saudi Aramco IPO. Elon Musk seems to have this funny public obsession with constantly comparing his corporate achievements to Saudi Aramco. For some reason, what is fascinating right now is that BlackRock is actively talking about investing billions of dollars directly into SpaceX. Whether BlackRock is trying to lock down a massive private allocation right before the company hits the public markets or trying to buy chunks at the official IPO is not completely clear yet, but what is completely obvious is that giant institutions are looking at SpaceX and saying, look, this massive puppy is guaranteed to get instantly included in all the major stock market indices. So we either need to get our massive investment exposure right now up front, or we will be forced to buy it later at a much higher premium. I am a little bit worried that the overall enthusiasm around SpaceX is getting slightly overheated, but you can absolutely see why the institutional market is so incredibly excited. There is an undeniable and massive physical shortage of actual hard data centers in the world. Right now, SpaceX might actually be able to turn their XAI division into a wildly profitable data center leasing company, especially given that massive blockbuster partnership deal they just struck with Anthropic. That was an absolutely brilliant strategic move because it completely shores up their revenue model. Ultimately, we want to see SpaceX succeed because a massive successful offering props up the entire hardware ecosystem, and that massive wave of liquidity will eventually transition into the lagging sectors like finance stocks and legacy software stocks. The SpaceX IPO is reportedly scheduled for the second week of next month, which means we are only about 4 single weeks away from witnessing one of the biggest market events of 2026. But let us get right back to the macro fixed income notes, because Treasury yields are doing some very scary things. The 30-year U.S. Treasury yield has officially broken above the critical 5% mark, and the 10-year Treasury yield has ripped past the 4.6% resistance level. Citigroup explicitly noted that these surging yields will heavily challenge the ongoing equity market rally. This is happening precisely because we are realizing that absolutely nothing of substance came out of the recent high-profile United States trade visit to China. I hate to sound incredibly pessimistic, but I called this exact outcome last week. People kept asking me what I expected from the China trip, and I told them flat out that nothing would happen. Xi Jinping currently holds significantly more strategic leverage over the United States because Washington has completely entangled itself in a diplomatic quagmire with Iran. Just look at the news updates from this morning. The United States officially demanded 5 strict conditions from Iran. They demanded that Iran completely give up its enriched uranium, provide 0 concessions on economic rebuilding, open up the vital Strait of Hormuz shipping lane, and completely stop supporting militant groups in Lebanon. In exchange for all of those massive demands, the United States offered to unfreeze less than 1/4 of the Iranian assets that were previously seized. Obviously, Iran looked at that lopsided offer and essentially told the United States to go fly a kite. Why on earth would they give up their entire nuclear bargaining chip and agree to 0 rebuilding aid when the United States will not even return their own seized cash assets? It shows a complete lack of diplomatic progress, and it highlights how much leverage Iran actually holds due to their physical control over the Strait of Hormuz. In fact, there are active military reports that Iran is deploying deep-sea submarines directly into the strait to make a naval blockade even tougher to crack. We are simply not getting anywhere with these international conflicts. We even had a drone strike hit a United Arab Emirates nuclear power plant facility this morning. Fortunately, the actual nuclear reactor was completely untouched, but a major electrical generator was destroyed. While no casualties were reported, it just proves that global geopolitical tensions are rising while real diplomatic progress is completely stalled. China saw this American distraction and completely threw its hands up. During the trade visit, we received far fewer Boeing aircraft orders than Wall Street was aggressively hoping for. We got absolutely 0 announcements regarding Tesla getting full self-driving approval in China. And we got 0 progress on NVIDIA chip sales, considering American companies have not been able to sell a single advanced H200 AI chip to China due to strict export bans. All we got was a tiny downsized Boeing agreement that caused Boeing stock to immediately tank. The truth is that Xi Jinping knows he holds all the cards right now. Donald Trump previously placed heavy sanctions on Chinese shipping companies that were actively importing Iranian oil. Those companies were supposed to pay massive tariff penalties for breaking the blockade, but Xi Jinping explicitly told his domestic shipping firms to completely ignore the American sanctions and refuse to pay the tariffs. And what did the United States administration do? Trump literally stated that they will make an official decision in the coming days and will likely just undo the extra tariffs entirely. In other words, the United States completely paper-handed their own sanctions policy. It is absolutely wild to watch. Now let us pivot directly over to the Goldman Sachs research piece because it is equally mind-blowing. Goldman Sachs pointed out that there is a massive momentum chasing herd mentality that is completely concentrated in what they call the everything AI trade. Institutional investors are systematically dumping their losing positions and using massive amounts of margin leverage to pile into the trending winners. Leverage is accelerating at a historic pace as big money participates in a relentless rinse and repeat cycle. Even though the overall stock market tape has incredibly bad breath, which means market breadth is dangerously thin, the market is officially ripping away from all the bearish investors who have been sitting passively on the sidelines in cash. This is exactly why I explicitly warned you back in April that this would be the most frustrating stock market rally in recent memory. Millions of retail investors got incredibly bearish, pulled their cash out of the market, and sat on the sidelines. They completely missed the massive spring rally, and now they are experiencing severe psychological FOMO and are going to end up falling into the market at the absolute worst possible time. That is historically how the retail crowd gets absolutely slaughtered. Even if you completely missed the boat on the hardware and chip rally, that does not mean you should panic buy at all. Time highs. Instead, you need to be calmly hunting for massive value opportunities in high-quality software companies and defensive assets, because those sectors are fundamentally next in line for the capital rotation. There are still fantastic deals out there on incredible businesses, but you will never find them if you only buy what is trending on social media. When you look strictly at the headline index levels like the SP 500, it easily feels like everything is completely overpriced and sitting at the absolute top of a bubble. But that is simply not true under the hood. In my private investor community streams, we literally sit down every single day and granularly tear through individual corporate balance sheets one by one. We analyze the exact fundamentals to determine if a stock is a genuine bargain or a total trap. For example, back in October of last year, when everyone was blindly hyping certain stocks up, we ran the numbers on Robinhood at its peak and realized its fair value based on core cash flows was only around $16 to $19. Understanding when an asset is fundamentally too expensive will save you thousands of dollars in lost capital. The analysts at Goldman Sachs openly admitted that while it is incredibly tempting to short this overextended market, you absolutely should not fight this upward momentum. Trying to buy aggressive put options right now is an incredibly dangerous game. Bank of America actually published a fascinating note in the Financial Times explaining how they are actively structuring highly creative put options to help large institutional clients reset their downside protection higher up. This option strategy allows investors to maintain a safety net if the market suddenly crashes, but it reduces their premium decay losses while the rally continues. In reality, this is just a fancy way of rolling options contracts, and it is a blatant sign that Wall Street market makers are looking to extract more fees. The more complex and arcane these option structures become, the more billions of dollars the big market makers rake in. They absolutely love high volatility, and they love selling this creative financial garbage to anxious investors. The reason market dips have been incredibly shallow in 2026 is because the massive long-only institutional community has an absolute mountain of dry powder and is completely ready to pounce as buyers the second a minor correction occurs. We are currently sitting at the absolute worst overall market breadth since late 2022, which means only a handful of mega-cap stocks are carrying the entire index. Meanwhile, retail trading volume has surged an astonishing 28% since mid-April. Regular, everyday folks are predictably late to the party. Once again, to make things even more volatile, the recent regulatory replacement of pattern day trader rules, with significantly less stringent margin requirements, means retail gambling activity is likely going to rise even further. You no longer have that strict $25,000 account limit holding people back from over-leveraging their small accounts. If we look at information technology exposure across global hedge funds, we are currently sitting at the highest tech concentration levels seen since January of 2024. Gross and net exposure to the tech sector are hovering near all-time historical highs. Everyone is piled into the exact same crowded room. Furthermore, among the SP 500 companies that have officially reported their corporate results, corporate capital expenditure grew by an astronomical 38% during the first quarter of 2026, while corporate stock buybacks grew by a measly 1%. Think about that massive divergence for a second. Mega cap tech giants like Meta and Google have completely pivoted. Their stock repurchases have plummeted off a cliff because they are forcing every single cent of their massive cash flow directly into AI capex and buying expensive server infrastructure. The only businesses that are still aggressively buying back their own stock right now are legacy software companies. For the hardware spenders, the reliable corporate buyback support that historically protected stock prices is completely drying up. When corporate buybacks disappear, it leaves the stock vulnerable to downward pressure when employees inevitably vest their stock options and sell their shares to go buy a new boat or a luxury car. Look, I am still fundamentally bullish on the long-term future of the United States economy, but we cannot afford to turn a blind eye to these underlying structural issues. None of this temporary data completely flips my long-term bull scale into a bear market, but it absolutely means you must prepare yourself for massive incoming market volatility. The Cerberus IPO is going to continue its downward spiral. The hardware sector will likely take a much-needed breather, but it still has structural legs to run through the upcoming SpaceX IPO next month. By the time we hit July and August, my macroeconomic crystal ball suggests we will see capital aggressively transition over into neglected high-quality software stocks. The ultimate takeaway here is that you must stop trying to play short-term trading games against Wall Street algorithms. You cannot reliably time the market. Instead, you need to rely on the undisputed mathematical fact that time in the market always beats timing the market. Stop keeping your hard-earned wealth sitting entirely in a melting cash account where inflation destroys your purchasing power. Build a disciplined habit of consistently dollar-cost averaging every single week or every single month into broad, stable index funds like VU, which tracks the top 500 American companies, or SHD, for high-quality dividend growth. If you want to build true generational wealth, you have to embrace long-term discipline, change your daily consumption habits, drive a reliable, older vehicle, live below your means, and automatically route your capital into cash-flowing assets. If you feel like you are missing these critical daily macroeconomic updates because the YouTube algorithm is hiding my videos, make sure to download my personal finance tracking app, where you can completely customize your notification preferences to only receive core stock market and Federal Reserve breakdowns. Thank you all so much for watching. Hit that subscribe button. Peace.